Hi, folks. Welcome to the Money Pit Group. Robert Quigley, Washington, D.C. Just to remind everybody, if you haven't subscribed to the channel, push the subscribe button. Give your comments below. Join the conversation. Help us make the channel a little more interesting. Today, we're going to begin drilling deeper into some of the topics that this channel is going to cover. This video is titled Scalping and Day Trading. And we're going to look at some parts of scalping and day trading. Overall, the channel is going to be rather negative on the practice of scalping and day trading, but we need to know why we're going to take a rather dim view of scalping and day trading. I mean, on the one hand, professionals make a huge amount of money from scalping and day trading. If you know what you're doing in the market, if you really know what you're doing and you got luck on your side, you can make a substantial amount of money day trading. But it is certainly a game where the odds are stacked against 95% of the people. And so ultimately, it's not the best way to get the most out of the stock market. But I want to start with scalping and day trading, and then the next video is going to be the Warren Buffett proper way of long-term investing. So the first question we need to ask, and I know some of this is going to be elementary for the seasoned traders and investors in the market. So bear with me because I'm going to pull out a couple of salient points which are often not even talked about, but here we need to address the issues. So the first question is, who are the players in the market? Well, you got buyers and sellers, of course, market makers, and the issuer of stocks. I mean, of course, there are investment houses and there are banks and there are regulators and there's the Fed. I mean, there are a lot of other players, but we're specifically focusing on the players in the momentary trade. Now, there are a couple of ways to look at what's going on in the market, and the two most popular ways of looking at what's going on in the market is what's called level 2 quotes, and those are available for all of the stocks that are listed on the stock exchanges. If it's in the pink sheets, which we rarely talk about here, you're only going to have one bid and one ask price. And then, of course, we can see the same across the financial instruments in terms of a level 2 quotation system. Basically, it's telling us the number of shares that are on sale or offered to be bought at different price points. And in contrast to that, we have something called the exchange order book. And the easiest way for folks to see the exchange order book, whether we're talking about NASDAQ or we're talking about the New York Stock Exchange, is to sign up for Bookmap. I'm not trying to promote Bookmap here, but it is the cheapest and most easy way for the retail traders, even professional traders, to see exactly what the exchange order book is. This is extremely important because what most people are looking at are level 2, and that only tells part of the story. And the reason why it tells part of the story is it's manipulated by the market maker. They don't have to put the whole order book up on their level 2 quote system. In fact, they will strive to make it look like an orderly market, when in reality, when you look at the limit order book on the exchange, you'll see a huge weight of sellers or a huge weight of buyers. I mean, so if you're going to be a successful scalper and day trader, you really want to see what is on the exchange limit order book. So that's Bookmap. Everybody knows you got longs or shorts. You know, longs, you're buying shares that hope are going to go up in value. You sell shares often you don't own that you hope is going to go down in value. That deserves a video of its own. But essentially, between the market maker, the buyers of stock, the sellers of stock, and then of course the company issuers, we essentially have a circular firing squad. When one participates in the market on a short-term basis, we're not only playing against other buyers and sellers, we're playing against the market maker. We're trying to get money out of the other participants' pockets, and the market maker is getting money out of everybody's pockets. There's a problem with that. I'm going to come back to it in a minute. So the next question is, what moves the stock price? Well, as we get deeper into these videos, we're going to talk about a lot of different indicators, and some of the most popular ones are moving averages, RSI, Keltner channels, Bollinger Bands, average true range, and the list goes on and on and on. I mean, there are many dozens and dozens of indicators, but all of those ratios were devised by Wall Street, and once upon a time they carried more weight and more accuracy. But like anything, the more people that use them, that means more people try to sort of beat those indicators, and then they lose value over time. So we'll come back to that in other videos. But on a more basic level, we're talking about supply and demand. So what moves the stock price is very simple. If you got more buyers than sellers, the stock is going up. If you got more sellers than buyers, the stock is going down. If your buyers and sellers are balanced somewhat, the stock is going to go sideways. Okay. How does the market maker fit into all of this? Well, if you talk to insiders in the financial system, and oh, by the way, market makers are very often all the banks that you can think of off the top of your head. So if you try to name the top 20 banks from your own personal knowledge, you'll discover that probably all of them are a market maker, and then you have others too that you've never heard of. But the market maker has a set amount of cash per stock, and they are the ones that put up the bid price and the ask price at any given time. So when you buy or sell your shares from the system, you're not buying from other participants. You're buying from the market maker. And when you sell your shares to the system, you're not selling to other participants. You're selling to the market maker. So the market maker, every transaction goes through the hands of a market maker. And when we have that situation, guess what? We are paying a road bandit's toll to the market maker. As far as the technology goes today, we don't need them, but we'll come back to that in a minute. So the other things that typically move stocks, earnings and the fundamentals of the stock financials. News and economics, that'll move a stock. And on a scalping and day trading basis, the biggest mover of the stocks are going to be the short-term traders' view of all of the variables that could possibly affect the stock, as well as all the normal variables of everyday life. Like, I need to sell because I want to buy a car, or I need to pay my kids' tuition, or I want to go on vacation, or whatever it is, or I'm going to buy because I'm going to save this money for retirement. So you've got all those variables that come in there. So on a short-term basis, it's the trader's view of all of these collection of variables that will actually move the market. Now keep in mind that their view of a stock and what it might be worth in the future, or what it might be worth right now, is very often, in fact most of the time, completely different from what that stock is actually worth, or it will be worth in the future. So that's a question mark for us, and that may not necessarily be the best way to trade. So let's go a little bit deeper. Scalper. What's a scalper? Scalper is someone like Jim Simmons. He's in a trade for 8 seconds. Somebody is trying to get a couple of ticks, trying to catch the move of one candle. They're not in the market very long. They're grabbing quick profits and doing it as often as they can. A day trader kind of falls into the same category, but the day trader basically opens positions at some point in the day and tries to close them all and go flat by the end of the day. And so okay, it sounds cool. What they're doing is they're seeing the price action go up and down in the market. They can see that billions, if not trillions of dollars are changing hands, and they just want to stick their paws in there and scoop up a little bit for themselves. But what are their win rates? Well, 85% of the time, scalpers lose. You'll hear numbers like, that people have win rates of, 50%, 52% of the time, 53% of the time, 75% of the time. And all of these win rates are correct for that individual. Believe them if they're saying it. But overall, you're going to lose way more than you win. So you might be asking, well, how do you win in this kind of situation? Well, people use stops, and if the price action goes slightly against them, they basically cut their losses and try again and catch that micro move and go ride it as long as they possibly can. So you take as many bites of the apple as possible, but the warning here is if you do that long enough and you don't hit a big winner, which is able to cover all of those losses, you'll be out of the game. And people blow up accounts all the time doing this. So why is it like that? What's the nature of the market? Well, it's a gyration. Markets are always moving in gyrations. Today is an up day, but the reality is stocks are always moving up a bit, always going down a bit. There are bull traps. Stocks start moving up. Market maker pulls it back down because he sees that there are not enough buyers to keep pushing it up. So the few people that did buy in thinking that they were going to get a short-term move are trapped. Price is going to go down low. Once the market makers see that someone's trapped, they're going to try to wash them out, because what it means is, they were able to sell high and they're going to buy that stock back at a lower price, and that difference is ultimately what they're going to keep. I mean, it's amazing that the system allows market makers to work against everyday, ordinary, even professional buyers and sellers in the market. There's something wrong with that, but nevertheless, that's a gyration, this constant movement up and down of stock as time goes by, and the market makers are able to game the system. All right, so what are really, if you're going to look at this in a professional way, what are the key indicators that's going to really tell you what you need to know to be a short-term trader? Well, those are going to be the volume of trades in the stock. What's the number of buy orders? What's the number of sell orders? That's often referred to as liquidity. Is there enough participants? Is there enough money in that stock that it's going to move? Or is it basically a dead stock? It's not going any place because nobody wants to trade it. The time of day, pre-market and opening, are the best times to trade on the short-term basis. The account size when you're trading on a short-term basis, never, ever, ever trade with a large position size, and that is determined by the size of your account. Because remember, you're playing a game where most trades are going to be losers, so you can't do this with a small account efficiently. You've got to have a pretty decent account. In fact, I would just suggest to anybody, if you don't have $100,000 in play money, I would not even think about this. But a lot of people will disagree, and a lot of people try to do it with much smaller amounts. But the result is more often than not heartache. So you want a decent size account. We're going to say at $100,000 entry level, and your position size. You may not want to put on more than 2 or 3%. Maybe 4 or 5% at tops of your account on that one trade. Personally, I've never used stops when I trade because I want to use better entries, better exits, and my account size to cushion the gyration. 95% of the time I win doing that, but a good 5% of the time I get stuck in trades for a long time. But ultimately I'm not dying a death by 1,000 cuts. Market trend. You're looking for a market trend, and I'm going to go over just a second here how you find that market trend, and then of course, unfortunately for stockbrokers, I'm going to tell anybody and everybody who's listening to my videos, never use margin. It's a fool's errand. Okay, if you open up an account, your broker's very happy to give you 50-50 margin. You put up a buck, that the broker will put up a buck. It sounds so nice. Good friends, wants to make money. No, he wants to take your money. If you're a margin player, there are rules that you got to play by. You're going to have to meet margin calls if the financial instrument goes against you, stocks, for example. And it gives the stockbroker a say in your trades. So, stockbroker may not have the same patience that you have. I mean, I can hold a trade for 6 months. I don't care. I mean, sooner or later, I'm going to get my money back on, that 5% of the trades that are going against me. A stockbroker doesn't want to wait that long. They don't have to wait that long. In fact, it's been enshrined in code that you've got like 3 days to settle up if there's a margin call. And then there are certain percentages that you got to have of money in your account to avoid margin calls. So essentially, just don't do it. I mean, the use of margin is really it's dangerous whether you're a professional. It's dangerous whether you're a stay-at-home retail trader or a casual trader. But if you absolutely know what you're doing and you've got years and years of experience and you're really on your game, then it would be a different story. But if you're a passive investor or a part-time investor, you're new at this, I would just say forget you even heard about margin. All right, so how do you determine a market's direction? Well, I do this every morning, and over the years I've gotten really good at it. I mean, 99% of the time, 99.99% of the time, I've got it right. So the way I do it is you simply read through the pre-market and the morning news, and you see if there's a bull or bear bias in the market. It's very simple. You don't have to read all the articles. I read through 500 headlines, for example, from all relevant sources, and I can see what's the flavor of the market. It's like a litmus test. It's okay. People are feeling very bullish today. People are feeling very bearish, and that's a good start to tell you where the market's going. Look at the European hours in terms of the futures market, or what we would call the pre-market. Is it positive? Is it negative? If the pre-market futures are positive and you've got a bullish news bias, guess where the market is going at the open? And that's really the key time you want to trade. It's going up. And if it's the opposite, the market's going down. All right, so here are a couple more tricks to the trade. You've got indicators, okay, and there are lots and lots of indicators that we'll talk about. But those indicators are telling us essentially, are stocks overbought or are they oversold? And like I said, it's got limited utility in today's world. But I'm putting that on the table. We'll come back to it. But one of my favorite indicators are indices. So, for example, I've got the Dow Jones Industrial Average up on one of my screens. In fact, if you look behind me, you can't see it in detail, but that's the Dow Jones Industrial Average right there. Now, the stocks are weighted, so each stock in the Dow Jones has a separate weight to it, which means that if that particular stock is green, heavily green, it's going to have an overall bigger influence on the direction of that particular indice than if it's a lesser weighted stock. So I've gotten into the habit where I look down the list of 30 stocks. I see how many green stocks, how many red stocks, which ones are green, which ones are red, and you get a pretty good idea just from looking at that, especially in the pre-market and the open, where the market is going. And just so you know, about 80% of the stocks follow the market direction every day. So whether you're trading futures or you're trading stocks, that is what you want to look for. You want to look for that market direction because that gives you a higher confidence, or what's often called a higher conviction in that particular stock trade. Another interesting indicator that I put up is what I call the Tech 6 indicators. So over here in this particular section right here, I've got the top 6 tech stocks. The reason why I do that is because they account for 45% of the NASDAQ 100, and they account for 25% of the S&P. So essentially, if every one of those stocks are heavily green, the NASDAQ is going to most likely be bullish, going to go up green, and then of course the S&P generally follows. That's the general pattern. Doesn't always hold, but just as a general observation. Of course, the opposite's true if it's red. And then if you got 3 green and 3 red on the Tech 6, you don't know what's going to happen. So it might be better to wait and see which bias takes hold, and then go in that direction. Whether you're going long or you're going short, or whether you're in the futures or a stock. One of the other indicators I put up is sector indicators. So there are 11 sectors. I've got those guys right over here in that area, and it's the same thing. Are they moving up? Are they moving down? Where have they moved in the last day or two? What's the strength of those moves? Kind of a very simple but easy way to tell where the market is going on a short-term basis. And then, of course, the other big one I have up here, you can't really see it, but should probably just move the camera over a little bit to give you guys a better feel. I've got 16 screens up here, by the way, and the New York Stock Exchange and the Nasdaq volume indicators tells me from the very opening all throughout the day, you know, what's the bullish volume, what's the bearish volume, and as the morning goes by and as the day goes by, you can see where the day is going without a shadow of a doubt. Those don't actually kick in until 9:30 when the market opens, and it takes a few seconds for the data to start going through. But the Dow components trade in pre-market, the tech stocks trade in pre-market, and the news is flowing 24/7. So you can begin to get an idea of the direction of the market. Like I say, supply and demand is what it's all about. That's what you're looking for. Supply and demand in whatever direction that you're headed in. Let's move on. So short-term, why is short-term trading risky? Okay, well, crowd psychology trumps facts in short-term trading, and this can be a big headache because you can set on a really nice stock, a super position, and then a fickle crowd who's manipulated by news can just do the opposite thing. And it just throws a great trading strategy right out of the window. And then you're like, man, what are these people doing? You know, don't they see this is a valuable stock? But traders are very neurotic. They're very jumpy type of people. And, you know, you've heard the rumors, sell the news or, let me see, get this right, buy the rumor, sell the news. You know, I mean, this is crazy. You know, go for the facts. But that's the reality of short-term trading is, you know, people want to avoid any loss. So, you know, they're going to be very proactive. And most of the time, that proactive behavior is contrary to smart investing. And it's even wrong. But it does impact the market. So essentially what that means is invariably, every moment of every day, there's overreaction to events. And again, this is not rational trading. This is, you know, we're gaming. You know, this is what's going on. We're playing a game. Now, if you want to know more about this topic, there were some links. There's a Swedish guy by the name of Christian. If you go to a YouTube channel called Chat with Traders and listen to his take on the markets, he's made millions upon millions over the last 15 or so years trading on a short-term basis, basically a short-term trend follower. He's someone who stands out. Jim Simmons of the Renaissance Fund, we all know he's got 8-second trades on average, and he's got $1 billion in his fund, and he's using computer algorithms to do these trades, and they've programmed, you know, 1,000,001 signals into their system to take advantage of this. But the truth of the matter is, if you boil it down, and I've never seen his computer program, but based on all the evidence I've seen through his interviews and experts in the field that know how algorithms take place, he is essentially looking for other people making mistakes in the market. Obviously, he's looking for mispriced stocks, but he's really looking for and taking advantage of other traders in the market, and that's a problem. I mean, we'll come back to the reform in a minute. As we all know, 95% of retail traders lose in the short-term trading game. However, if you're on a road to a trading career, there is a positive. Learning everything there is to know about short-term trading, the process, the indicators, will make you a much better long-term trader, because it will tell you, it'll inform you in terms of how the market operates. It will definitely give you better entry points. But when you're a longer-term trader, the entry points and the exit points, precise entry and exit points, are not really that important. But nevertheless, it gives you the knowledge to see what is going on in the field of play, and that can very often in itself present good longer-term trading opportunities. Okay, so that's just sort of the generalized discussion of scalping and trading. Believe me, you can go through YouTube and the internet, and you can find guys that will dissect that topic 1,000 times over, because there's tons to say about it, and there are many different trading styles. But our objectives here is just to kind of winnow down to some very, very positive, proven trading processes that work, and we're starting, with the shorter term side, and we're moving to a more longer term type of investment. All right, so the next topic, because remember, we are on the road to the White House here. We're going to go to the White House. We're going to do it in a very unconventional way. We're going to do it in a way that many independents in America would probably do it if they were to sit down and think, well, that would be a good place for me to exercise some of my skills and talent. And this YouTube channel is designed to bring together a crowd of supporters who share a similar vision in terms of law reform and where we want things to go. And all of this will become clearer and clearer, and we'll build as we go along this process. But so now we've come to the topic of law reform in relation to this topic of short-term trading, scalping, and day trading. And here I want to focus on the market maker, because we're living in a different time today. Technology has advanced to the point where we don't need market makers anymore. They are a roadway bandit's toll on passersby that does not need to exist. So let's just go over a few topics that we often hear. So one of the most shocking things about market makers is they never lose money. Why is it fair for someone to play in the stock market and be in a position where they never lose money? This is craziness. I mean, the information, if you Google market makers on Google, YouTube, you will find some of the videos I'm talking about. You'll find lots of the press releases I'm talking about. But essentially, they're either making the spread, the difference between the bid and ask price, which is sometimes small, sometimes large. And if they're not making a profit, then they're breaking even. And remember, they're the ones controlling the bid and the ask price. They're the ones that have an inventory of shares that they can put up to sell. They're the ones that can push that price and up and down the price supply chain. And don't believe for one moment that they can't, because they can and they do. And so that's just totally unnecessary, because the NASDAQ and the New York Stock Exchange, they have the computer technology. I mean, there's no reason in the world why I need to deal with a market maker. I can put my shares up for sale, and if somebody wants 50% of them, fine, they buy 50% of them, and the other 50% will be bought by somebody else. It might not be the same second or the same minute or the same day or the same part of the world. It doesn't make a difference. I mean, if you buy shares over 100 different price points, you're still going to average them out to one price. I mean, so the whole idea that we need a market maker today is total rubbish. It is just a fancy way for exchanges to collect more money from the market participants, because they charge market makers a fee to be a market maker for a stock in that exchange. It's not free. Okay, so let's see what's next. There's a nice phrase in this world of market making, and it's called cashing their box. And they're allowed to make a profit, and they're allowed to buy low and sell high and buy low, and this is a process. And I would encourage anybody to use those terms and do a little bit of search on the internet, and you'll find actual market makers talking about what they do. And boy, it'll make you think twice. Okay. Let's see, what's another good point here? Now, one of the contrary arguments that you'll hear to what I'm saying about market makers is if there were no market makers, the difference between the spread and the bid and the amount of liquidity would be too great and not enough. And that's totally irrelevant. Don't believe that for one single minute. Simply for the simple reason that if the spreads are bigger and you are an investor and a long-term participant in that particular stock, you're not really going to care what your exact entry point was and what your exact exit point was. Because if you're in it for the long term, then think about it for a moment. You're going to buy at a price today because you're expecting that price to be much higher or substantially higher 6 months down the road. And the difference between the spread and the bid makes the bid and the ask, the spread makes no difference. It only makes a difference to somebody who is scalping or day trading, because they're trying to cut their costs as much as possible, and we don't really care about that. I mean, that's not something we want to encourage in the market. That's a high risk game for the vast majority of players, and it's only a few, very well funded and highly talented individuals that are basically sucking the money out of everybody else's hands. So the priority is not to promote the short-term trading, and therefore the whole idea of $1 billion of momentary liquidity, or a 1 penny spread, it just makes no difference to a long-term trader. Okay. Like I said, I refer to these guys as roadway bandits, and that's the way they are. We should just eliminate them. Now, if you look at some stocks, what you'll find, we had a discussion earlier about Bookmap. So if you look at the number of limit orders that are placed above the current price, and if you look at the number of buy orders placed below the current price, what you'll find is the market maker will be reluctant to move the price up to the limit orders at slightly higher prices, simply because they don't want to take money out of their own pocket, and they will hold that price level until they see buyers coming in, and then when buyers go in, they will let the new buyers push that price up and buy those limit orders, and then of course if one of the participants hasn't put that many orders there, then the market maker can add or subtract and can change the amount. But essentially what I'm saying here is the market maker is protecting their own financial interest by keeping that price at a point until the volume reaches a level where they're going to be able to make substantial profits. It's totally contrary to what everybody else thinks is going on in the market. Okay, so if you got a horde of sellers, that price is going down. Okay, because the market maker doesn't want to pay large prices for that. If you get a horde of buyers, that price is going up, because of course the market maker wants as many bucks as they can for those shares. I mean, it's just totally different than the way people think is happening. Okay, so but ultimately this setup allows the market to be gamed, and this is just one way to game the market, and this is something we need to think about. So if I were in the White House, I would call the chairman of the SEC over and say, look, we're going to make some changes, and we're going to start here. So put your do your study and put your proposals on the table, and what's a better way for us to organize the market that is cheaper and fairer for the traders in the street, retail traders basically. So remember the whole liquidity issue. You'll hear market participants jump up and down and say, well, oh my gosh, if you don't have market makers, you don't have liquidity, and it's all a red herring. I mean, it's just craziness. I mean, how many trillions of dollars are traded in the stock market every day? I mean, someone can correct me on this, but 16 trillion comes to mind, and we've got something on the order of a 23, 25 trillion dollar annual economy, and we're almost trading our whole economy every day in the stock market. Yeah, don't listen to for 1 minute. We let the entire world participate in the U.S. stock market. We don't care who you are. We'll take everybody's money. But this whole idea that we need market makers around for liquidity reasons it's a non-starter. Okay, so let's move on to the next topic, algo trading. This is another big problem. I have this massive problem with algo trading, because even though Jim Simmons is the iconic example, and he's a bright guy, and he's a very charming guy to listen to, but what's really happening is anybody and everybody can go out and program a computer to buy and sell stocks in microseconds. In fact, if you take Bookmap, one of the trading platforms that I have, remember this is where we can see the order book on the exchanges, and you can break this down to the exact trade at every price. And when you do this, you will see that computer programs are all over the place. They are buying and selling in milliseconds. I mean, they're buying and selling in such time frames that the human brain is not designed to comprehend that. I mean, it's so small, it has no meaning to us. But wow, at the end of the day, an organization like Jim Simmons puts up $100 billion. This is nuts. Where did that money come from? Well, like I said, they're taking it from the market. They're taking it from people who don't know what they're doing, who don't have the proper amount of skills to avoid the traps. So that's a problem. I mean, the stock market was designed for investment. It was never designed to be a gaming parlor. It was never designed to be a casino. I mean, that's why we have Las Vegas. That's why we have Atlantic City. That's why we got the lottery down at the local 7-Eleven. No, this is supposed to be safe places to put your money so it grows along with the companies that you're invested in. It was never designed in the beginning. It was never designed to go out and just basically take all participants' money and the smarter you are, great. You make a fortune. You did a good job, and screw everybody else. That's a problem. So humans have a serious unfair advantage, and this is even getting worse. I mean, let me tell you, give some examples. They've got these computer programs designed to buy or sell based on the words of a news release, or the words of a Fed speech, or the words of a presidential speech, or the words of a earnings announcement. I mean, it is nuts. I mean, you guys know the English language. I mean, you can say things, but if we can add inflection, we can put emphasis on one part of the word, one part of the sentence, or the other, totally changes the meaning. And if you're using this as a computer, if you're trading with a computer algorithm, and you've programmed these language variables in there, they're not catching it most of the time. And of course, people are going to say, well, that's what AI is for, and that makes this problem even worse. So here's an issue, and in order to bring fairness to the field, I would totally advocate just abolishing the ability to trade financial instruments with a programmed computer. It's not fair. It's taking advantage of folks that have worked really hard for their money, and it's taking away from the legitimate purpose of building resources over life for a better future. Whether people want to buy a house, they retire, they send their kids to school, or whatever it is. This temporary gaming the system so some dude can go out and buy a nice sports car today. This is not what the stock market was all about, but this is what it's become. So Wall Street's been allowed to operate a casino, and like all casinos, the house gorges on the lion's share of the money that flows through their hands. Now, the only way to beat this is, as a punter, that is to invest for the long term. So that's where we are at this video. I'll say it again. We need to abolish the ability to trade stocks and financial instruments with algorithms, computer programs. This is a people kind of business, and people should be the only ones allowed to do this business. And I would go as far to say, look, if I was in the White House, I'd say, look, Mr. SEC Chairman, here are the penalties we want. If we catch somebody trading with a computer and an algorithmic program, then the penalty for doing that is we're closing their account and we're taking every penny of that account, and they've lost that for good. You're not going to do it, and it doesn't matter whether it's done by a massive investment house like Goldman Sachs, or pick the favorite one. I don't mean to pick on Goldman Sachs, but I use Schwab, so let me pick Schwab. Okay, you do that Schwab, we're taking all your money. I use TD Ameritrade, which is also owned by Schwab. Okay, you guys do that. We're just going to close those accounts down. We're going to take all the money, and that's that. Because really, if you're going to treat the markets as a career, then it has to be a game where as many people as possible win. And if you've got 5% of the people winning and 95% of the people losing, that is gambling. Okay, and in fact, you got better odds in Vegas. You might as well go to Vegas and choose black or red on the roulette wheel, because you got a 48% chance of winning. So that's where I stand on this part of Wall Street. So I hope everyone's doing well today. Please subscribe to the channel. If you got comments, drop them in below. Join the conversation. If I've said something right or wrong, if I've ruffled your feathers, if you have something to add to the conversation, by all means jump in, and hope everybody has a great day. Until next time.